Good morning, ladies and gentlemen. I'm going to look at some of the general issues that apply from a legal perspective on enforcement of loans. I'm going to focus on whole loans. There's some additional issues that arise on CVAS, but probably not time to discuss those, but we can in the subsequent discussion if you like. I'm going to look at some general points first of all, and then just see very quickly how they're applied in a couple of jurisdictions, generally in France. So I think it's generally well known that there's a fairly creditor-friendly enforcement regime in the US and the UK. There is administration set Chapter 11, but in general there's a fairly effective process of enforcement. But very much a different regime applies in Europe, and there are a number of constraints on enforcing security in Europe. And that can be requirement to get court orders, requirements to go through an auction process, requirements to appoint a court-appointed insolvency officer, so you don't necessarily control the guy who's actually running the deal and the workout. So those are complications, and sometimes a full workout, for example, in Italy, could take about 7 or 8 years, sometimes on a worst-case basis. So if you're looking at buying a portfolio of loans, that gives rise to complications, because from an IOR perspective, you can't really accurately assess when you're going to exit. And of course, during the negotiations with the lender, you can't speak to the borrowers. So you have to make certain assumptions as to the percentage of portfolio that you can exit consensually or not. On one level, you can sometimes obviate those restrictions by enforcing at the holdco level, which would normally be a Luxco level. There are certain rules to comply there, but sometimes it's a quicker process. But it does underline the need, as Harry said, for there to be quite often a consensual solution to the process. And that may be changing the waterfall and the capital stack to give the borrower some retained interest, letting the borrower walk away, maybe consideration of releasing a guarantee, or sometimes selling the loan back to the borrower through the so-called discounted purchase option, which we're seeing quite often at the moment, usually at a discount, but which gives both parties a clean exit. The new lender is in a position to do a deal with the borrower because there's no history, and obviously its cost base is different from the bank, so its IRR return calculations will be different. So I'm going to look just quickly at some of the legal issues that do arise. And the first one is COMI, central gain interests, and this is really where an entity is most closely associated. It's very similar to tax residency, but it's not the same. The courts look at where you're running your assets on a day-to-day basis, and whether that is ascertainable to third parties, and take into account the bank accounts are, accounting principles, the employees, etc. What's the significance of that? Well, in Europe, the applicable insolvency law to an entity will be the law of its COMI, which isn't necessarily the same as the law of its incorporation, or sometimes the law which applies to some of the underlying documents. So that can give rise to complications. For example, if the COMI of an entity was in the UK, you may potentially find you're subject to the administration regime where you thought you weren't. Or you'd be subject to local law, it's called UK law, in terms of determining whether a security could be set aside for political preference, etc. There can be particular complications where there's a split debtor law structure as part of some group arrangement, where the COMI is in different places, etc. So it's messy. It doesn't always impact on security, because the EU legislation says that it shouldn't prejudice the enforcement of rights in rem, but how that applies on a jurisdiction by jurisdiction basis partly depends on where the security is and the local law. A second issue is the sensitivity with director duties. They owe enhanced duties once a company becomes insolvent or is likely to become insolvent. Firstly, their duties if they allow the company to incur liabilities when they know there's no reasonable prospect of it meeting those, they can have personal liability. Also, at a particular point in time, when there's no reasonable prospect of avoiding insolvency, the duty of the directors passes to a general duty to the creditors, and at what point that is quite often unclear, and again, at which point it is will depend on the local jurisdiction, so that creates its own uncertainties. And this can be a particular concern for administrative directors of non-resident vehicles, who are obviously just sort of professionals and concerned about personal liability and whether they're covered by their insurance, etc. You do see situations where directors want to resign, And the other side of that is that sometimes a borrower may threaten to resign to its directors as a way of putting extra pressure on the bank, because the bank then has companies that effectively have no directors. There's a further sensitivity there for the bank, because they don't want to become shadow directors of the company where they could incur the same liabilities. There's an interrelationship here actually with the COMI, because if you change your COMI of the company to try and prejudice the rights of the bank, is that consistent with your duty to act in the general interest of creditors? It can be, but clearly you need to go through that analysis. What other sort of arguments arise? Well, a borrower who wants to negotiate a position with a bank may challenge the enforceability of the loan. It may argue that the alleged default's been waived or that a stop-all has arisen. Banks will traditionally send out reservation of rights letters, but they're not always effective. Again, it's a function of local law and circumstances. They may again argue that the bank has acted in bad faith. In some way that precludes the bank from taking particular actions. Now clearly at that point the relationship is completely created. But in Europe some of those arguments have greater cogency than they do in the UK. And there's a slight trend where the courts favour borrowers in certain cases, probably because of the sort of negative view of banks generally. Other issues that you would need to look at: the hardening period, i.e. could the security be set aside and been created in the period prior to insolvency? Is there a springing mortgage situation? In certain jurisdictions, primarily Spain, mortgages weren't perfected to reduce registration and capital duties, and there can be complications then in converting that into a perfected security once the company is becoming insolvent. And another thing that emerges is that in documents, quite often you need to look at the vintage, and you'll find a kunai in the documents, quite often from the bank's perspective, where documents were originated on a formulaic basis, and there's some point that a borrower can take. Other issues, depending on where you are on the capital stack, you could get crammed out. So if your business plan is to take an interest and exercise negative control, you can't assume that you're always going to be able to do that. You've probably seen a lot in the press about CVAs, company voluntary arrangements in the UK. That's less relevant in a lending situation because CVAs can't bind secured creditors. But there is something similar in the UK called schemes of arrangement. You need 75% approval of each class of creditors in a court order. But once the relevant order is obtained, the court has to be satisfied that it's fair and reasonable, then that will be binding on all the creditors. So sometimes that could be used as part of pushing through a restructuring of the loan or a debt for equity swap, etc. A point worth noting is that it's quite easy to bring a non-resident company within the scheme of arrangement regime because you only have to demonstrate there's a connection with the UK, which might be that some agreements are governed by UK law or there's a UK asset. It's a much less restrictive test than the test for COMI. Clearly looking at, you need to analyse the waterfall, and this really depends what the business plan is. Are you trying to get an income return? Is there PIC? Is your return based on the fact that cash will come through at a sort of increased margin because the borrower's in default? Are you assuming amortisation? So you need to see and analyse to what extent that's going to be stopped by cash traps, or whether the cash flow will be diluted by local withholding taxes, etc. Also, clearly, you need to consider your position in the waterfall in the context of everyone else's rights, particularly priority of further advances. This may be governed by the intercreditor agreement, which will say to what extent the senior lender can advance further monies. But you can also have a situation where the company and administrator requests further advance, and that advance is treated as an expense of administration and has priority. Or in certain European jurisdictions, claims against claims of employees or tax have priority, for example in France. In the UK, again, there's a concept of a prescribed part of a certain category, 600k being ring-fenced for other creditors. Again, in terms of the intercreditor, you need to make sure that to what extent the senior lender can control the refinancing date by refinancing the senior loan. Sometimes, because of anomalies in documentation, they implicitly have control over that process because of the way terms are defined. Tax also comes into play in terms of the sort of negotiation between the lender and the borrower. One aspect here is the whole issue of capital allowances and depreciation charges, particularly in the UK. whereas open to the bank sometimes to trigger a disposal that would result in the acceleration or clawback of the depreciation allowances claimed by the borrower, which a bank might seek to exploit in its discussions with the borrower. In certain cases, the borrower can obviate that by doing certain things structurally, but there's some sensitive issues there. Again, if a bank enforces security over a charge over shares, it can effectively take over the company, control the filing of tax returns, and then that can enable it to trigger liabilities, etc. There's tax issues on the forgiveness of debt. If a bank forgives debt, that can trigger a tax charge within the borrower. So again, that needs to be structured around, which one can normally do, but needs to be looked at on a case-by-case basis. Clearly as well, the purchaser needs to look at transfer tax issues if it's trying to enforce its security. And it also needs to consider its own tax position in terms of ensuring it's avoiding withholding tax. When the loan is repaid, that will be treated as capital and not income, and that it's not going to be taxed on an accruing basis on any roll-up of interest on the PIC structure. Just one or two other very quick things. Another issue potentially is the seniority of these swap liabilities, particularly relevant in CMBS transactions, but can also apply sometimes in whole loan transactions. And that's a very sensitive issue because the desks, different desks within the bank take different views of the position now because of their respective rights. Again, you need to analyse quite carefully your voting rights. For example, does the swap counterparty have voting rights based on the amount the swap's out of money? Do you automatically acquire the voting rights by purchasing the loan? For example, in Spain, until recently, you buy a loan but wouldn't be able to vote. There's only been a very recent change in legislation to enable that. Similarly, if your strategy is to convert debt into equity, there may be a Cram down mechanism locally, but you also need to consider the position at equity level, and certain jurisdictions, an equity shareholder could block that. And again, it's quite easy to do something that, in certain jurisdictions, could require a banking license. So you need to care in terms of how you're structuring the process you take in negotiations. Particularly arises where you actually enter into a revised loan. So that's really just looking at from the borrower perspective, just very quickly from the bank perspective. I think this is all, Harry's already, Michelle already commented on this. We're certainly seeing these issues also become more relevant in terms of bank behaviour. Basel III obviously is coming in on a phased basis, but analysts are applying it already. Slotting is a fundamental change. If it is introduced, there's a slight qualification to that now, but it actually applies a risk rating of 70% even for a loan that is strong. And for a loan that's in default, the risk rating I think is effectively 1,250. So it's a significant change, and it really prevents the bank from taking an optimistic view of the likely amount of their recoveries. Some of the things have already come in. The EBA accelerated 9% Tier 1 capital for 17 European banks. The Financial Stability Board are proposing enhanced counter-cyclical buffers for so-called SIFIs, systemically important financial institutions. And of course there's the enhanced capital requirements for retail banks. So these are all pressures on the banks that they need to take into account when looking at their portfolios. Also there's sort of political pressure on them to lend into SMEs. And to that extent, they need to free up their capital to enable themselves to originate those further loans. They've got the issue of potential counterclaims from borrowers on swap liabilities. And they're constrained quite often if they're dealing with an operating asset. We've seen this on a number of occasions where a strategy that the bank might otherwise want to implement in the context of a real estate investment, it can't implement in the context of an operating asset, for example, a PropCo-OpCo structure, because it can't bring the employees onto its balance sheet, etc. So those sort of things drive the banks, but equally another relevant issue is they've got their sort of holding costs, financing costs. And the LTRO financing mechanism that the ECB introduced last December has clearly reduced the funding cost of the bank with these loans. RBS have said publicly that they don't consider themselves in the market to sell loans at the moment because they say their funding costs are less than the market and therefore it doesn't make economic sense to sell loans, which I suspect is slightly disingenuous because it doesn't take into account the fact that the assets are declining during that period. So those are just some general issues. I just now very, very quickly just look at France and Germany just to pluck out some of those issues to see how they can apply. Perhaps the principal thing in France I've mentioned would be Sauvegarde or sort of safeguard. And this is a sort of similar arrangement to administration where steps can be, a company can effectively impose a moratorium. They have to be cash flow positive at the time, but it has got difficulties that it can't overcome. And a classic case here is Défense, which was a Windermere CVAS transaction where the initial courts held that Sauvegarde would apply. The banks appealed it, Court of Appeal said it didn't apply, and then it went to the Supreme Court and they decided in favour of the borrower. And there's lots of different issues arising from that, but two interesting issues are that A, the banks maintained that Sauvegarde wouldn't be relevant because the relevant company was based in Luxembourg. And the French court said no, COMI applies, and the COMI of this company is in France. And again, the banks argued that the only purpose of the borrower of claiming Sauvegarde was to frustrate the bank and get out of its contractual obligations by restructuring the loan. And the court said, well, that's fine, that's implicit in what the insolvency regime says. They shouldn't be precluded from doing that in the absence of fraud. That's led to a practice in France of like sort of double holdco structure as a way of trying to avoid that. But then that's given rise to certain tax complications on transfer pricing. So it sort of shows how some of these issues impact on what can be done. And then just very quickly on Germany, we're finding a lot of people look at Germany, looking to do deals in Germany at the moment because obviously you're hopefully buying primarily from a non-German bank, exiting the market, potentially a discount, quite a large discount with a German bank. So if you've got your pricing right, at least you're managing your loans in an economy that is strong and is still growing. There are difficulties on enforcement. You have to go through an auction process. You can't assume that every event of default can be enforced. It has to fall within certain categories. If you take too many rights as a lender, you can be subject to what's called equitable subordination, which means that they treat you as a quasi-equity holder. So again, you need to be careful that you don't push your sort of controls too far. Banking license is very much an issue in Germany. If you buy a loan and enforce it, that's fine, you can do that without a banking license. Once you start restructuring a loan, changing the margin, changing the repayment profile, that is banking business for German purposes. Now you can get around it again if you're doing it outside Germany, or you maintain the argument that you're not carrying on banking business, you've been approached on an unsolicited basis by the borrower. But it's quite hard to sustain that if you clearly bought a portfolio of loans and it's part of your underlying business plan. There have been, interestingly, and this is actually a trend in other European jurisdictions, actually, for example, Spain and Italy, but there have been some helpful changes in insolvency legislation in Germany earlier this year. One is to free up more so-called debtor in possession financing, which gives priority to new advances. One is to ensure that a recalcitrant equity shareholder can't block a debt equity conversion, which is otherwise approved by everyone else. Also, they've accelerated a process of an initial creditors committee, and the creditors can choose who goes on that committee, so they have more say in who the final insolvency officer is. And there's also a short form of quasi-administration procedure being introduced, albeit you have to be insolvent before you can initiate that.